Observed, as we know, raised interest rates by 25 basis points or 0.25% on Wednesday and signaled that its rate hiking campaign may be nearing an end amid concerns about stability in the global banking system. Is this a sign that inflation has peaked, or is a risk in the banking system causing the Fed to be more cautious? And if so, what can we expect from the central bank going forward? Here to discuss is Pence Capital Management's Chief Investment Officer, Dryden Pence. Thank you for joining us here today. And just reading through your notes here, I like acronyms here, and you're talking about a potential transition in narrative from there is no alternative in bonds to bonds are back, y'all, baby. So from Tina to baby, can you kind of explain what you're thinking here?
Absolutely. So for so many years when we had zero interest rates, you had this, there is no alternative market, forcing people into equities. But now that we've had this rapid rise in interest rates, bonds are now a legitimate and meaningful alternative for investors who are looking to build income and value in their portfolios over time. So that's why we moved from Tina to what we call baby. Bonds are back, y'all. And when you can look at a situation where with minimal risk, a person can get between 4 and 5% on short-term money. That changes the planning considerations of a lot of people and how they are going to think short and long-term about their portfolios. It makes a big difference. It's a sea change that we haven't had in like 15 years. And I think it's very, very important for people to pay attention to how significant that opportunity is in their long-term investment profile.
Yes, and as part of that sea change, we had an absolutely disastrous year last year in both bonds and equities. I'm wondering if you expect any kind of revaluation this year similar to what we had last year with tech. And just in general, what do you like in equities right now?
Well, talking about the revaluation, you see the reason why you had this massive change in bonds last year was you had this very rapid increase in interest rates driven by the Federal Reserve. When we're nearing the end of that cycle, and I think we're going to find a much more stable interest rate environment going forward. Fed probably has, a quarter point left maybe, and then they hit a pause button for quite a while, and then we're going to move from a regime of rising interest rates to possibly lower interest rates, but we don't see that till 2024. So I think that environment is important. And when we move that to equities, Jared, it's important to recognize that companies right now have a hard time predicting their total cost of capital because interest rates are rising. They don't know when the Fed's going to stop. Once that happens, then companies can understand their cost of capital and payments in terms of trade, and companies adapt. So you'll begin to see earnings estimates, forward guidance, and all those things get a lot better for equities going forward once the Fed hits the pause button. Now, if we talk about sectors, we like
yes.
Defense. Yeah, okay. We like weak sectors, and we can talk about some companies as well. But we like defense because the war in the Ukraine may end at some point. But even when it does, the world has learned a valuable lesson. NATO has learned a valuable lesson. There used to be 9 countries that spent 2% of their GDP or more on defense. Now it's gone to 19. And so when you look at the interoperability agreements inside of NATO, U.S. companies like Lockheed Martin and Raytheon currently have a 2.4 times 2022 revenue order book. They're basically booked up for the next two and a half years. The Javelin missile cost $175,000. We pay for it. It takes out a $3.2 million Russian tank. I like the math, and I think that trend is going to continue. So we like defense. We like healthcare because tremendous healthcare expenditures are going up. A lot of the money is provided for the government, and we think that that's going to be stable going forward. And we also like infrastructure. So infrastructure because we have a large transportation bill that has been funded. There's $500 billion running at infrastructure companies. We've got to rebuild our roads and bridges. So those are the 3 things that we think are really stable in this environment that continues to be somewhat volatile.
All right, we got time for one more. I'll give you the floor. Anything you'd like to highlight to our audience here in terms of investment opportunities or what you're seeing on the horizon?
Well, I think we have to recognize that the Fed is probably going to go up maybe one more and then pause. And I don't think we see a pivot until next year. And I think that's very important. I think it's very important for people to consider that we've only seen the net effect of about half of the Fed raising so far. Lags are 4 to 9 months. And so when you're thinking about your portfolio, you've got to recognize that all of the Fed action is yet to work its way through. So we're going to probably see a minor recession in the last half of the year, but that creates opportunities. And the sectors that we like, and I mentioned United Health. I didn't mention United Health, but I'll bring that one back. But defense, healthcare, and then infrastructure. Those are areas that you have resiliency in this market that's going to be somewhat volatile going forward.
All right, appreciate that. Pence Wealth Management's Chief Investment Officer, Dryden Pence. Thank you.